There's also what are typically called general and administrative expenses or operating expenses. And those are basically everything else's in the world that are a part of like running a business that may not be directly related to the generation of the patient production. So the way that we look at that, you go in and you look at things, you've got fees for accounting fees, you've got advertising fees, you've got different insurances and things like that. This is where it gets messy, and this is where financial analysis doesn't really tell you a whole lot. We can go in and look at trends and things like that. Again, December was a big month. Looks like the doctor took out some extra money in there. Looks like we had more wages, again, to this clerical staff. So that probably correlates back to what I was saying of there being somewhere more likely to be a 3 payroll period month in that month. There was just some other numbers that came in as well. We had some amortization expense that was booked that hasn't been booked in January and February yet, which is just tax stuff. Depreciation in December, probably a catch up for some depreciation entries or something like that. And then there's just a whole bunch of other stuff like office expenses and things like that. We do count clerical team members and front office team members as operating or G&A expenses because it is a support to the revenue side of things. So we do typically separate those out in terms of showing those things. But in terms of like looking at these things, we typically just look at profit levels of like, hey, are we generating a profit from a net income perspective? And our thing that we do here in terms of tooth and coin, how we do this is our G&A expenses is really more about separating out into line items, things that are discretionary expenses, items that we have a whole lot of control over as a dental practice owner that may not be considered to be needed in every single practice. And the reason is we're trying to create similar sized financials to where practice A can be comparative to practice B. And the way we do that is by normalizing all of the discretionary items. There's a whole lot of subjectivity to the owner's proclivities of what they want to do in terms of how they have their setups of how much they pay themselves for reasonable compensation, what they do in CE. Some people like to go on big cruises for their CE. Some people like to go and get their CE from just their state board. Some people want to go and take $20,000 implant courses because they want to learn how to do new services. There's some people that will spend a whole lot in computers. Some people won't. There's a lot of nuance to that. And so we try to separate them out so that whenever we do compare these to other practices, we can actually have a view of these things. So in terms of profit and loss, generally what I will do is I'll generally back out anything that I consider to be discretionary so that I can get a better understanding of actual profit in that practice from a traditional profit and loss standpoint. So typically what I'll do is I'll go in, if there's a doctor family member on there. Now that doctor family member could be literally the front office person, their office manager maybe, but we still put that as a separate line item so that we are making sure that we're keeping up with that in a proper way. I'll back out taxes that are related to the owner. I'll usually back out anything that's just specifically related to the doctor or the doctor's family. I'll back out payroll taxes as well. I'll typically back out expenses and interest income. So for the people that are listening in, I'm going in and actually line by line doing a formula in Excel to back out different items. In other words, I'm summing them up at the bottom to be able to common size this. That's probably a pretty good set of items on here that are discretionary in nature. So I'll keep those as the items. So if there's ever like meals and entertainment on there, I'll usually back that one out as well. And then I'll typically also back out depreciation expense. I'll typically back out amortization expense if there is any, because whenever we're doing EBITDA is earnings before interest, taxes, depreciation, and amortization. And I'll give you a number. I'll go and do that for every period. And then I can add that number to my net income. It gives me a bit better of a percentage of like how profitable this practice has been, a total value number. So I then go and do it similarly to how I look at the cost of services percentages up there. So I'll go in and I'll take the total number that I come up with, my add backs, and I'll take that as a percentage over the course of all 4 months. And so for this practice, December, obviously, since it was a heavier payroll period month, had a much lower profit percentage. But this practice, in terms of just the profit percentages from a more traditional EBITDA standard, has an average of 47% profitability. Pretty good. 45% is the number that a lot of people shoot for. So this number is above that on an average on a 4-month basis. So that's pretty good. This practice seems to be pretty healthy, pretty in line. We're doing a pretty good job of being profitable. Now, if we were looking at this from a pure EBITDA standpoint, there would be another number that's a little tricky in there, and that's an add back for seller. And basically what you do is you normalize what the owner paid, you remove everything from that, and then you go in and you add back how much you'd pay that person if someone would be working in that person's seat. So let's say that this dentist would pay someone similar to them $10,000 a month is how much they pay for this person. So you take that, and that'd be negative $10,000 a month for 4 months. And then you go in, you add that number to the total number that's in there. And if you're looking for the EBITDA number, the private equity or a DSO would be looking at, that'd be the number that they'd pick out for you if you're looking for EBITDA. So this is the income statement. This is how you analyze the income statement. At the end of the day, you're really looking for these percentages down here. You're really looking for volatility in revenue. You're looking at these costs of goods sold. You're trying to get an understanding of the static, how much it takes to run this business on a regular period. So you can go in here and you can compare operating expenses as well. Another thing that you could do that could be helpful is after you've normalized everything, all these expenses that are discretionary, is to remove the discretionary expenses from the total operating expenses to give you an understanding of about how much of the G&A expenses you currently have on a monthly basis as well. That's something you could also do to be able to understand, like, hey, how much does it cost for me to run this business, right? So in this one, the total operating expenses was $38,000. You'd subtract the $20,000 add back. So you'd have about $20,000 in operating expenses. And that looks to be fairly consistent, $18,000 to $20,000 every month, maybe 25 in December, 15 in November, it looks like. So in general, this practice costs 31 cents on the dollar to service the revenue, and it costs about $20,000 a month in G&A expenses about it. So that's profit and loss. Now what I'm going to do is I'm going to give you the financial analysis that we give to all of our clients on a monthly basis to help with understanding how the business is running and how the business is going. So we create a custom management report for each of our clients every month for this. And so I'll show you that now. This is February's for this client. And we call this 4 questions report. That's meant to show you how profitable you were, how well you spent your money, how much cash you made, and where the money went to. And yeah, it just shows general profitability and things like that for the practice. As I mentioned before, I go top to bottom in P&L. I also go top to bottom in the 4 questions reports. For this client in February, they had $100,000 in revenue in February. They're averaging over the prior quarter. So our quarterly rolling trend is 93,000. So if it's a February report, that means the average is of February, January, December. And it's a rolling quarterly average. We see a trend on here. Was last month better than the trend or worse? Did we go up or down? Same thing on profitability. Did profitability go up or did it go down? Break-even point. This is a number that's not on a financial statement. I think this is one of the most important numbers to understand as a small business owner, because this is when you start making money. This is where you start making profit in the business. And so you go in, you create a profit, you understand how to do it. This client can tell themselves like, hey, if I want to make $1 million a year and I got to get to $80,000 a month in net profit, then if I'm at $53,000 in break even, I got to add 80 on top of 53, spend no extra money, be able to generate that much more in revenue. Pretty powerful to be able to do that. We also have that year-to-date column on there also. We have a cash balance on here as well. We use cash as a liquidity measure against the break-even point to be able to see how things are going. That's one of the first things I tell people to hone in on. If you aren't liquid enough in your business, you need to work on that first. So try and save up to be able to be at least 100% in break-even. 200% over that is too much in my mind. You should actually remove capital if you get above 200%. Each client's a little bit different in like how they view capital and their liquidity and things like that. But that's our general recommendation of how to do that. So cash compared to break-even point, it's good. So I mentioned earlier when we were analyzing the balance sheet, like the amount you have in your business account is important, but it's impossible just to tell by just some blank number. So you need to have something to measure it to. And what we tell people to measure it to is that break-even point. Because that break-even point is whenever you start making money. And the logic behind that is generally, if something happens to the dentist where they can't practice for a few months, generally the way the math works out is you can usually flow to practice for 2 to 5 months on a month's worth of break-even in your capital account, because you'll have some inflows of capital and then you'll have your expenditures over time. It's just how it typically works out. Because whenever you're not there, a lot of production hasn't been done. You typically aren't open as much. A lot of your other expenses go down, and dental supply costs or lab fees and things like that as well. So that's generally why we say to do that. You'll generally be able to flow at like 2 to 5 months with a month's worth of break-even in there. So that's the reason to do that. Also on break-even, we do include loan payments, but we don't include owner benefits or non-cash items to calculate that. And we do that on a regular basis. So that is something that we tell each client to pay attention to every month. I tell people, if you see that report, if you look at one number on there, look at your break-even point and be watching that, because it's a trend. It's not static. It's dynamic. It goes up and down over time. So pay attention to it and look at it every time. Because if I go in here and compare this to, say, January's report, so January, the break-even point was 46,000. The average of the prior quarter was 54,000. So prior month in January, it was only 46,000 in terms of the break-even, but in February, it was 53,000, and the trend went up a little bit. but still pretty consistent. So around 55,000 is the break even for this client. Then the second box here, the how well did I spend my money? That's commonly called a benchmark. So we're looking at, as a percentage of your revenue, how much did it cost for you to do the different categories of expenses in your practice? And how does that compare to the industry standards? So we have a prior month, same thing, prior quarterly average. We have a year to date on there as well. Green numbers are good. Red numbers are areas to be paying attention to. And green numbers are good. Black area numbers are within the range. Red are ones you should pay attention to or be aware of. The important piece of this to understand, and this is something that takes a lot of nuanced understanding of the analysis of a dental practice to really comprehend, is that just because it's red doesn't mean that you're doing something bad. That's really important for people to contextualize and understand. Being red just means that there's some piece of information that's happening with your practice that makes you be slightly above average to the trend. So if I say, hey, we got practices in here that are startups that are brand new, we got practices that are $10 million in revenue, we got DSO offices, we've got all these things associated with that. There's going to be just a whole bunch of numbers in terms of the population of the data set that creates these industry standards. It's going to be really, really low and some are really, really high. And the averages come into this little bit of a range here, and you're just a little bit above it. I tell people that is a symptom, right? That is a symptom. That is not a diagnosis. And it's definitely not a treatment plan. Another important thing to understand is that this whole report, you should be able to review this in like 5 minutes. You shouldn't be spending a ton of time analyzing your financial performance because there's just not a whole lot of insights from financial analysis from the financial statements. You just don't get a lot out of it. There's not a whole lot of value to it. The value really comes into the practice management analysis after you have this contextualized in your head, right? I tell people, hey, just because the supply cost number is like 7.1% and it's like 0.1% above the industry standard, that doesn't mean you got to go and like blow up your whole dental supply purchasing process. It doesn't mean you got to go hit up your supply reps for a whole bunch of savings and monies or something like that. It doesn't mean that you got to burn everything to the ground and start over again. It just means that you ended up being higher than average from a mathematical formula when we divide one number by another. What I can tell you is that whenever these numbers become red, is that generally it's not about spending. It's generally about one of two things. And that is either one, it is production-based, or two, it is capacity-based. So in other words, you've got an issue with production or you've got an issue with capacity, one of the two. No one that is a CPA that just does financial analysis can tell you which of those two is happening here. Anyone that says that they can is probably being dishonest. And because inside of production, it could be a bunch of things. It could be like, well, we're not seeing the patients that come through the door. We're not treatment planning enough, right? It could be that our average treatment plan size is not enough. It could be that our treatment plan conversion is not enough. On the capacity side, it could be that for the number of people we have working here every day, that we don't have enough patients coming through the door. We're built for a practice that can handle more patient flow. Even in just those few things I just said, those could be diverted down into even further things of, is it from a front office side of things, or is it from the assistant side of things? Is it operatories that we're using effectively? Is it that, we're not doing enough crowns per patient visit? It's not, we're doing enough crowns per patient visit, but we're not getting enough yeses to it. Or if we're getting enough yeses, we're not getting enough people to pay us for it. There are literally hundreds of things that it could be. So this is a symptom sheet. It's a symptom monitor for you to be paying attention to over time with your practice to help understand things and keep an eye on things. So just because it's red doesn't mean it's super bad, but red does mean you need to pay attention to it over a course of time to a trend to be an area where you could potentially be doing something a little bit better. It's not an indictment or anything like that, but it is something for you to be paying attention to. I've had lots of clients that have numbers that are in red that are just happy as can be with the number being where it is, because they're running the business the way that they want to run it and how they want to live their lives and how much they can do. They may have actually already solved the problem. They may realize that, hey, I've got these team members that could do better, but I don't want to have to be hounding on them every day to be able to do better and perform better and all these other things. They make my life as easy as I need it to be. And so I am happy with that. And that's fine. That's absolutely fine if that's how they want to be. So this is how we do it. This is how we monitor. This is how we show our clients in under 5 minutes a month how their business is doing from a performance perspective. The next step is how much money did you make? On the profit and loss, there's a number here. So the prior month, prior quarter, year to date information. So if I go back to that profit and loss, let me just check this real quick. The income statement, if you look at February's, it says $31,424 was their net income. Net income doesn't mean a whole lot, and I'll show you here. So this one says $31,424, but the practice owner actually made $46,000 that month. So they actually made more money than net income thing said. No business owner runs their business based off of how much the realized practice profit is and the net income from the income statement says. They run off how much cash flow they have, right? So we show that to everybody every month, every quarter, every year to date as well. And then finally, there's always the question of, hey, well, Jonathan, you said that I made $46,000, but my capital only went up $6,000. Why is that? It's because of all the different things that happened inside of your practice. The practice had distributions of $20,500. We had owner benefits of $17,000 that was in there. We paid $2,000 or so in loan transactions. So of the $46,000, $6,000 is still in the business account. So now we're looking for $40,000 from the prior month. And we had $20,500 in distributions. So now we're looking for $20,000. We had $17,000 in benefits that was paid to the owner. So now we're looking for $3,000. We had about $2,000, $3,000 in other transactions down here that was where the rest of that money went to. And can very quickly show it back. And we do that over the prior month, as well as the prior quarter, as well as year to date for our clients as well. And so that's how we analyze it. One of our big things we're trying to do with Tooth and Coin in 2025 and into 2026 is to even enhance this even more. Hopefully that was helpful to be able to see things, how we were doing. In terms of my suggestions for that practice owner, everything looked good for that practice. I probably should give my team members to give me some practices that have some more issues of things to be paying attention to. And so if you're interested in seeing a practice that may need more help than that practice, everything's going pretty consistent. I tell a lot of dental practices to aim for somewhere between 1.2, 1.5 million a year in revenue. This practice is averaging $93,000 a month in revenue. They're getting pretty close to that. The profit margins are pretty good. It seems like that practice is doing pretty well. There's not very many areas I'd be telling that client to try and optimize or anything like that. Hope this is helpful. Hope this is interesting. I'll maybe try and do this once a month as a way to be able to have some good content for you guys to be able to see how I analyze practices. Hopefully that'll help you better understand how to analyze your dental practice so that you can be understanding of how to be able to look at your business performance. And again, the goal of all this is to not have you guys have to spend a ton of time reviewing these things, because what I always say is that complexity is the enemy of execution. And again, if you're taking more than 5 minutes a month to analyze your business's financial performance from a dollars in, dollars out perspective, then you're probably spending too much time doing that. And you'd be better off spending that time getting a conceptual understanding of how the practice is doing from a dollars and cents standpoint, and then tying that into the practice management side of things through maybe the use of some type of business intelligence software or a practice management consultant or something of the like. So I hope this was helpful. And until next time, this is Jonathan Van Horn, Tooth and Coin. Thanks for listening to the Tooth and Coin podcast. If you enjoyed the show, we'd really appreciate it if you could leave us a 5-star review as well as a written review. Your feedback not only helps us improve, but also helps other dental professionals find our podcast and benefit from the financial insights that we share. So thanks for your support, and we'll catch you in the next episode where we'll continue to explore the business side of dentistry.